In the previous section, we examined the various types of title insurance policies available in Arizona, focusing on how each serves distinct purposes in protecting the interests of buyers, lenders, and other parties involved in real estate transactions. Building on that understanding, this section takes a closer look at the two primary policy types: the owner's title insurance policy and the lender's title insurance policy, and explores their differences in coverage, purpose, duration, cost, and benefit. Both play crucial roles in maintaining the security and stability of real estate ownership, yet their functions and beneficiaries differ significantly. Purpose and beneficiaries. The owner's title insurance policy is issued for the protection of the property owner, typically the buyer. Its purpose is to safeguard the insured's ownership interest in the property against losses resulting from defects, liens, or claims that existed before the date of the policy but were not discovered during the title search. It provides the owner with assurance that the title to their property is free from legal challenges that could threaten ownership. This policy benefits the buyer and their heirs for as long as they retain an ownership interest in the property. In contrast, the lender's title insurance policy, sometimes referred to as a loan policy, protects the financial institution that provides mortgage financing. It ensures that the lender's mortgage or deed of trust is valid, enforceable, and holds a first lien position on the property. This means that if a defect in title arises that affects the lender's ability to foreclose or recover funds, the title insurer must compensate the lender for the outstanding loan amount. The lender's policy protects only the lender's interest, not the buyer's, and remains in effect until the mortgage is paid off, refinanced, or released. Coverage and scope of protection. The owner's policy protects the insured owner from a wide range of potential title defects, such as forged deeds or fraudulent conveyances, unpaid property taxes, or liens not recorded in public records, errors in legal descriptions or recording, undisclosed errors, or missing signatures on deeds, lack of access to the property. If any of these issues surface after closing, the title insurer must defend the owner's rights in court, and if necessary, pay for covered financial losses up to the policy's limit, usually the purchase price. For example, if an undisclosed heir later files a claim asserting ownership, the title company will either clear the title or compensate the insured for their loss. The lender's policy, on the other hand, focuses solely on protecting the lender's lien position and loan security. It does not cover the owner's equity or personal losses. Coverage includes invalidity or unenforceability of the mortgage, priority, disputes with other liens, fraud, forgery, or errors that affect the lender's security interests, legal defense costs related to enforcing the lien. For instance, if an error in a previous deed results in a title defect that prevents the lender from foreclosing on the property, the insurer must compensate the lender for the remaining balance of the loan. Once the loan is paid in full, the lender's interest, and therefore its policy coverage, ceases automatically. Remember that the seller pays for the owner's, buyer's, title insurance policy, and the buyer pays for the lender's title insurance policy, if the buyer is obtaining a loan. Duration and policy limits. The owner's policy remains in effect for as long as the insured or their heirs owns the property, offering long-term protection that often extends for decades. This continuity of coverage is particularly valuable in Arizona, where properties frequently pass through inheritance or long-term investment ownership. The policy amount is based on the purchase price at the time of acquisition. The lender's policy, by contrast, is temporary and limited in duration. It remains valid only while the loan is outstanding. Once the borrower repays or refinances the mortgage, the lender's interest in the property and the coverage under the policy ends. The policy amount is tied to the original loan amount, not the property's market value. Cost and payment responsibility. In Arizona, it is customary, but not legally required, for the seller to pay for the owner's policy and for the buyer or lender to pay for the lender's policy. This division of cost is reflected in the Arizona Association of Realtors (ARR) residential resale purchase contract, though the allocation may be negotiated in the purchase agreement. Both policies are typically issued simultaneously through the same title insurer at a discounted simultaneous issue rate, reducing overall cost. Policy coordination and recordation. The issuance of both policies typically occurs after the closing and recordation of the deed. The escrow officer coordinates with the title insurer to confirm that all liens are cleared, documents are properly recorded, and the title commitments requirements are met. At that point, the title company issues the owner's and lender's policies, each covering its respective party's interest. This coordination between escrow and title ensures compliance and maintains integrity in the chain of title. For example, in a Scottsdale transaction, the title company issues an owner's policy for the buyer and a lender's policy for the mortgage company. A year later, an unpaid contractor files a mechanic's lien related to work performed before the sale. The owner's policy covers the buyer's defense and potential loss. However, if the lien were to threaten the lender's ability to foreclose, the lender's policy would protect the lender's position and reimburse the outstanding debt. This example illustrates how both policies operate independently, yet complement each other in safeguarding different interests. Legal precedents and statutory authority. Arizona courts have reinforced the distinct purposes of these two policy types. In First American Title Insurance Co. Revs. Action Acquisitions, LLC 2008, the Arizona Supreme Court clarified that title insurance is a contract of indemnity, not a guarantee of ownership or market value. This means that insurers are responsible only for compensating actual financial loss resulting from covered title defects, not for preventing disputes or guaranteeing appreciation. The case reaffirmed that coverage depends strictly on the policy's language, exclusions, and conditions, whether for the owner or the lender. Similarly, in Burkons versus Ticor Title Insurance Co. of California, 1991, the Arizona Supreme Court emphasized the fiduciary responsibilities of title and escrow professionals, requiring them to act honestly and disclose material facts. Together, these cases illustrate that while title insurance offers powerful protection, its scope is defined by the specific policy type and the insured party's role in the transaction. Discussion: what is the key difference between the owner's policy and the lender's policy? Answer: the owner's policy protects the buyer's ownership rights, while the lender's policy protects the lender's financial interest in the property. When does coverage under a lender's policy terminate? Answer: when the mortgage is fully repaid, refinanced, or otherwise released, ending the lender's security interest. Why do both the buyer and lender typically receive separate title insurance policies? Answer: because each has distinct financial interests that require independent protection, the buyer's equity and the lender's lien position. Review summary. The owner's and lender's title insurance policies serve complementary but distinct functions in protecting the parties involved in real estate transactions. The owner's policy safeguards the buyer's ownership rights against defects or claims that existed before closing, while the lender's policy secures the lender's mortgage interest by ensuring lien validity and priority. The owner's policy remains effective for as long as the insured owns the property, whereas the lender's policy terminates when the loan is paid off. Both policies are typically issued simultaneously at closing, with costs distributed according to Arizona custom and contract terms. These distinctions are supported by Arizona law and confirmed by case precedents such as First American Title Insurance Co. v. Action Acquisitions and Burkons vs. Ticor Title, which collectively underscore that title Insurance is a contract of indemnity designed to protect against financial loss, not to guarantee future outcomes. Understanding the difference between these two policies enables licensees to better advise clients and ensure transparent, legally compliant transactions that safeguard all parties involved.